Everyone, it's Atasha McPherson, Managing Director of Hall Wealth Management, and I'd like to welcome you into the year 2026. Also wanted to take a moment to say thank you. The past year has been incredible, and we loved being a part of your journey and helping make your dreams a reality. Whether you've been crushing your goals, starting new projects, or just figuring things out as you go, it's been an honor to be along for the ride. And just know we will not stop being alongside of you. We're going to keep showing up, keep sharing what we know, and keep supporting you every step of the way. But today, I want to shift gears a bit and look ahead into 2026. What trends should you be watching? What opportunities are on the horizon? And let's dive into the outlook for this year and talk about what we could realistically see happening: the good, the challenging, and everything in between. Let's get into it. First, let's start with the economy. While the U.S. economy should be sluggish in the first half of 2026, it is also expected to avoid a full blown recession due to the tailwinds of easing monetary policy and business friendly dynamics within the One Big Beautiful Bill. The lagged effects from a slowing job market, softer wage growth, and nagging inflation will dampen growth in the first quarter of 2026. But as businesses and households regain their footing from uncertainties during 2025, we expect 2026 to grow close to 2.1% higher than 2025, but not as fast as 2024. Fiscal spending and strong business investment in artificial intelligence infrastructure is expected to provide crucial support for the economy. The insatiable demand for cutting edge technologies like data centers, advanced semiconductors, and AI driven software is fueling significant capex by tech giants and businesses across various sectors. The demand for intellectual property will be a pillar of growth, and we expect intellectual property will have an increasing slice of the economy. Inflation will not likely decelerate as fast as policymakers would hope, yet we still expect the Fed will continue its rate cutting campaign in 2026 as it balances inflation concerns with risks to the labor market and overall economic growth. Ongoing factors such as new tariffs could push general inflation slightly higher, but softer household demand will cause inflation pressures to recede in 2026. But in the near future, investors will have to bear the burden of hotter inflation. Mortgage rates are primarily influenced by long-term interest rate dynamics, which are shaped by the fiscal outlook and the 10-year U.S. Treasury yield, rather than just the Federal Reserve's short-term policy rate. When fiscal policy results in large deficits and heavy Treasury issuance, investors often require higher yields to compensate for increased supply and inflation risk, pushing mortgage rates higher. But 2026 should be a year of declining mortgage rates, creating some support for home buyers. Geopolitical and trade uncertainty will stunt the Eurozone's economic growth. High relative energy costs, coupled with broader structural weaknesses in productivity and technological capacity, limits the Eurozone's international competitiveness and risks constraining growth below U.S. levels. Plus, many member states are implementing fiscal tightening measures which act as a drag on growth. Japan's goal of the virtuous cycle of sustainable inflation, driven by robust wage growth, looks more likely in 2027 than in 2026. The nagging questions for investors are the pace of future rate hikes and the timing of the terminal rate, which is complicated by ongoing global economic uncertainty and the government's desire to support growth. Now I will cover stocks. The S&P 500 surged more than 80% over the first 3 years of this bull market, excluding dividends, far outpacing historical averages. If history is a guide, then this bull may have more room to run. The S&P 500 has averaged a 12.8% gain historically during the fourth year of bull market since 1950, with 6 positive years out of 7. In previous instances, when the Fed cut rates when stocks were at or near record highs, there's been 28 cases of this, the S&P 500 was 13% higher on average 12 months later, with 93% of those 28 periods producing gains. When the US economy was not in recession around a rate cut, the average 12-month return for the S&P 500 increased to 18%, with gains in all 21 periods. Consensus estimates for 2026 capex from the five hyperscalers is expected to approach $520 billion, a roughly 30% increase over this year's estimated and an estimated 1.6% of the US economy measured by nominal GDP. In terms of dollars that can help drive the economy and corporate profits. Nothing is bigger than AI right now, and it is very unlikely to change anytime soon. The Magnificent Seven has been responsible for more than half of the S&P 500's earnings growth the past few quarters and will likely continue to play a significant role in growing earnings in 2026. The wide gap between the Magnificent Seven's earnings growth and the rest of the market will likely persist well into 2026, supporting large cap growth stocks, but monitor the gap potentially narrowing. Now we'll get a little bit into the midterms. The Republican majority in the House is razor thin, as they hold just 219 seats, one more than 218 needed for control. This represents the slimmest margin since 1931. It significantly increases the risk of a shift in power next fall. In 20 of the last 23 midterm elections, the president's party has lost seats in the House, with an average decline of 27 seats. Historically, midterm years have been challenging for equities. Since 1950, the S&P 500 has averaged a modest 4.6% gain during midterm years, with an average maximum drawdown of 17.5%, making it the most volatile and weakest performing year in the fourth-year presidential cycle. Once political uncertainty subsides, markets tend to rebound. Let's navigate the bond space now. Market pricing suggests that the Fed's rate-cutting campaign could end by the second half of 2026 with a tough rate of around 3%. If market pricing is right, it's likely the 10-year Treasury yield will remain around 4%. It's unlikely the Fed will cut rates to the levels that would take the 10-year Treasury much lower. So we think a 3.7% to 4.25% 10-year Treasury yield range for 2026 is appropriate, at least for now. Upcoming, likely dovish, changes to the FOMC should help prevent the 10-year yield from drifting meaningfully higher. Despite recent challenges, the broader credit market is not in crisis, and we do not think we are on the cusp of a systemic credit issue. Our issue is with market valuations. Credit spreads, or the additional compensation for owning risky debt, remain historically tight given these raising risks. While yields may appear attractive, spreads remain below longer-term averages and are arguably not providing sufficient compensation to take on these emerging credit risks. Agency mortgage-backed securities and investment-grade corporates should outperform Treasury securities given the higher starting yields for both asset classes. But given our view on rising risks within the corporate credit markets, we still have a marginal preference for mortgage-backed securities over corporates. As the Fed continues to cut short-term interest rates, cash yields will come down as well, which should allow high-quality fixed-income markets to outperform cash holdings once again. A stable or slightly higher interest rate environment and even tighter spreads are needed for high yield and leveraged loan sectors to outperform core sectors. With that said, let's get into the alternative investment space. Merger and acquisitions activity has been trending up both in terms of the number of deals and value of the deals, supported by the deregulatory policies, rate cuts, and increased demand in AI-related transactions. As currencies go, despite recent volatility, the dollar's long-term uptrend remains intact. The 2025 drawdown found support from a secular trend dating back to 2011. A sustained move above 100.35 could confirm a short-term bottom, targeting the 104 to 105 range. Speculative positioning and sentiment are improving, suggesting potential upside from short covering. To break the long-term uptrend, the dollar would need to fall below the September lows, which is near 96. That would likely signal a new bear market cycle, shifting from consolidation to a resumed downtrend. Key downside risks for 2026 include escalating trade tensions, a weakening U.S. economy, and a capital rotation into outperforming international markets. When it comes to commodities, several macro catalysts could support commodity prices. Potential rate cuts and lower treasury yields may weaken the dollar, providing a tailwind for commodities. Stimulus from the One Big Beautiful Bill and a possible recovery in China could further boost demand. Trade policy remains a wild card. Additionally, the green energy transition and surging investment in AI infrastructure are expected to drive sustained demand for several commodities. While these factors could collectively push commodities into a supercycle, headwinds remain, such as a bear market in oil. It remains a consistent outperformer across commodities and has even exceeded the S&P 500's return since its bear market low in 2022. Russia's invasion of Ukraine in early 22 and the seizure of over 300 billion of Russian dollar reserves prompted a swift central bank pivot to sanction immune assets. Gold has been a major beneficiary as central banks have continued to ramp up purchases with no signs of slowing down. Gold prices have been further supported by safe haven demand stemming from conflicts in the Middle East, trade policy uncertainty, and even the passage of the One Big Beautiful Bill, which renewed fiscal deficit concerns. Thanks so much for watching, everyone. I hope this gave you some clarity and maybe even some excitement about what's ahead. Now, I want to hear from you. What questions you have about 2026? What are you most curious about, or maybe even concerned about as we move through this year? Drop your thoughts in the comments or an email to me. I know the future can feel uncertain sometimes, but here's what I want you to remember. You've got someone guiding you. We're in this together and we've got you. Whatever 2026 throws your way, we'll be right here helping you navigate it and making sense of it. So stay focused on what matters to you, and let's make 2026 incredible. I'll see you soon. Thank you.